Hi, my name is Jane Arana and I'm an investment companies analyst at Quoted Data. I'm here today to talk to Ross Teverson, manager of the Jupiter Emerging and Frontier Income Investment Trust. Hi Ross, thank you for joining me.
Hi Jane, thank you.
So first off, what does the typical Jeffy investment look like?
So there is no one typical Jeffy investment, but a number of our stocks do fit into one of three different themes or structural changes that we'd highlight. So one of those is technology enablers, companies which are critical to some of the big technological changes taking place in the world today. So companies selling, for example, into the electric vehicle supply chain or into the supply chain for IT hardware. And companies where we believe the growth prospects are very good and that's not reflected in valuations. Another type of company we're invested in are companies that are exposed to rising financial inclusion. So rising financial inclusion is typically thought of as bringing the previously unbanked into the financial system, but actually it can be a lot more than that. And what we're seeing in many emerging and frontier markets is traditional banks leveraging that existing deposit franchise they have, embracing financial technology, and introducing a whole new range of products to their client base. So the third theme that we're significantly exposed to is rising consumer discretionary spending. And we're exposed to it in a way that perhaps people wouldn't immediately expect us to be. So one way is through medical diagnostics. We think here in the West of medical diagnostics as something that's completely non-discretionary. If you need a test, you get a test. But actually in a lot of emerging and frontier markets, this is something which is paid for out of pocket. And as people become wealthier, they're certainly spending a lot more on medical services. So as I say, no one typical holding, but I think a lot of our holdings can be described as fitting into one of those three structural changes: technology enablers, rising financial inclusion, and rising discretionary consumer spending as well.
Sure, thank you. And can you explain the process and the timescale from discovering a company to making an investment in it?
So certainly the timescale between coming across a company for the first time and investing in it, that can vary quite a lot, and I'll explain why in a moment. But the process is very much the same across all of our investments. We put a lot of emphasis on meeting with companies, meeting with company management. So almost every day, myself and the rest of the team are speaking to company management teams. We're looking for a positive change in the business, a long-term positive change that we believe is not yet reflected in valuations. So there's a strong valuation discipline in our process. And we also need to have a catalyst for the market to come round to our way of thinking and recognise that positive change that we've identified. Now, on the question of how soon we invest in a company, if we've identified positive change, really the crux of the investment case is whether or not that's priced in. And there may be companies that we monitor for some time where we think, well, the valuation already reflects the positive change we've identified. And then something will happen in the market, a sell-off, for example, and that creates opportunities for us to get a good entry point into one of these long-term opportunities. And actually that's something that's been happening quite recently with some of the Chinese names that were previously quite highly valued, having all been sold off. I think that is creating opportunities.
Right, and can you talk about an example?
Yes, so one example, a company which we quite recently purchased in the investment trust, is a US-listed Chinese company called Niu Technologies. So that's spelled N-I-U, but pronounced Niu. And that's a company which is one of the world's leading producers of electric scooters and mopeds and motorbikes. So that is a segment which has already grown very strongly in China, in their home market, and they're just starting to make inroads into the European market and will be exporting significant volumes to the US as well. I mean, electric scooters are a very compelling product. The total cost of ownership for an electric scooter is less than for a petrol-powered scooter. And yeah, it's a better user experience as well, so we'd expect that to grow quite well and quite rapidly. Now, we've been looking at the company for about 2 years, and if you roll back 2 years, it was really a very expensive stock then, and we felt that all the long-term growth was more than priced in. But the sell-off in Chinese equities, which has been quite broad-based, as I say, that's creating opportunities, and in our view, one of those opportunities is Niu.
So are some emerging and frontier markets easier to find income in than others?
I'd say that's definitely true. So if you take Taiwan as an example, which is a country that's quite consistently been our highest or second highest country exposure in the investment trust, there is quite a developed culture of paying dividends in Taiwan. And we're seeing companies that, despite having good growth and despite having areas to reinvest cash, they're also paying a portion of their cash flow quite consistently back to us as shareholders. Another market that has quite a good dividend culture is Pakistan, actually. So we're invested in one bank and one auto manufacturer in Pakistan, and we see a very good level of dividend consistently coming from both. Somewhere else where it's a bit harder would be India. So there's not a strong culture of paying dividends in India, and so that makes it a bit more challenging for us as income investors. And I would also say that if you look at the US listed Chinese tech stocks that are obviously quite big in the emerging markets index, a lot of those are still holding on to cash rather than choosing to pay any of that cash back to shareholders as a dividend.
Do you see that changing maybe?
It's an interesting question because certainly at the moment, not many of those US listed Chinese companies are paying a regular dividend to shareholders, but there definitely are exceptions. So NetEase, which is a Chinese game developer and publisher, so for example they published the Harry Potter game franchise in China, that's a company we've been invested in for quite some time, and it does pay a regular dividend. And we're also researching other opportunities that fit into a similar mould to NetEase, so there are companies that do.
Right. What are your biggest concerns at the moment for emerging and frontier markets?
I think that when we look at the risks for emerging and frontier markets, the main risks are really specific to individual markets. So clearly at the moment, investors are concerned about the heightened tensions around the Ukraine, and people are looking very closely to see whether any kind of diplomatic route out of the current crisis can be found. And of course, US-China relations is something that has, I wouldn't say even gone hot and cold, it's just gone from cold to slightly less cold and back to cold again. So there are clearly geopolitical concerns specific to individual markets that we have to keep a close eye on. None of those geopolitical concerns would completely put us off being invested in a market. If you take Russia as an example, where we have around 7% of the investment trust invested in Russian companies, the valuations are very attractive. The dividend track record is very good for those companies, and we believe that for our holdings, the risk from sanctions is relatively low. So we think there's a strong case for maintaining some Russian exposure despite the risks that obviously come with that. And then when we look more broadly at emerging markets, I very often hear people say that rising rates in the US should be a concern for emerging markets. And clearly there have been cycles in the past where that has been quite a headwind for the asset class. I don't think that is necessarily the case today. We've been of the view for some time that actually very highly rated equities in markets like the US, companies trading at very high PEs, are more vulnerable to higher rates than many emerging market businesses, which are trading at more attractive valuations. And I think we've seen evidence of that in recent months, actually, when there has been talk of higher interest rates. And I'd also point out that for many companies in emerging and frontier markets, their balance sheets are very strong. The majority of companies we're invested in have got net cash in their balance sheet. So the vulnerability to rising rates in terms of the impact on borrowing costs, that really isn't a consideration for a lot of emerging and frontier market companies. And that puts us in a much better place than we may have been 10 or 15 years ago.
Sure. One of the hot topics at the moment, and perhaps encouraged by the pandemic, is the global supply chain crisis. How are emerging frontier markets dealing with that?
Well, we've seen some really quite unusual disruptions. So I talked earlier about the Chinese electric scooter or electric motorbike company NIU, which is starting to ship electric scooters into the European market. Now for them, the cost of shipping a scooter has gone from $100 prior to the supply chain disruptions that we saw last year to $500. So that's quite a big impact in the short term. What we've seen though is that already the order book for Europe is picking up very strongly, and a lot of that increased shipping costs will simply get passed on to consumers in higher prices. And I think that point about companies and industries being able to pass on higher prices, I think that's really important, because we are seeing evidence of pricing power from quite a few of our companies. It's really very clear in the semiconductor sector that if costs go up, those costs get passed on to the end consumer. And that's obviously good for maintaining stable margins at a corporate level. So, supply chain disruptions, they are significant, they are ongoing, but in most cases, companies are managing to mitigate the impact.
Brilliant. And just on COVID again, are there any particular markets that didn't cope as well as others?
There were definitely markets that were more impacted in the short term by COVID. So I think the worst impact was for those markets that had relatively low access to vaccines and where there was quite a high reliance on tourism. So the impact on somewhere like Georgia, where we're invested in Bank of Georgia, that was quite high in the short term because there's a very strong element of tourism in the economy. Now, I think what's interesting is that we've already seen quite a strong recovery in those economies in places like Georgia, in places like Kenya as well. And that's before we've even seen tourist arrivals recover that strongly. So tourist arrivals are recovering, but we're still relatively early in the process of that happening. So I think as this year develops, we'll see tourism potentially become a revived tailwind for some of these economies. It would be wrong not to mention China. I mean, China's a huge part of the emerging market index, and obviously China was quite unique in being able to remain pretty much COVID-free throughout most of 2020 and 2021. That was obviously very good for China in the short term, but what we're seeing now is China's policy of wanting to maintain zero COVID. That's actually very difficult with the Omicron variant being as contagious as it is, or as transmissible as it is. And actually I think it's proving difficult for China right now, being able to strike a balance between having restrictions in place to keep COVID infections very low and allowing the economy to properly recover. And it's actually an easier process in some markets outside of China.
One of the few positive things we've seen out of the pandemic is the absolute boom in digital innovation on a global basis. How have emerging markets and frontier markets coped in that situation?
So we've definitely seen the same kind of acceleration in uptake of digital services in emerging and frontier markets that we've seen in developed markets. And actually this has been quite a powerful accelerant for the change that I was talking about earlier when we discussed financial inclusion. So we are invested mainly in banks that are already quite established in emerging and frontier markets, so established deposit franchises. And those are profitable businesses before you add any kind of fintech element to them. But actually what they've been able to do is really roll out much more rapidly their mobile platforms, mobile banking products and other products like insurance and savings. And so we've seen perhaps 3 or 4 years worth of progress made in just a year and a half.
Brilliant. And you mentioned the emerging market consumer and how that's changed in recent years. Can you talk a bit more about that?
Well, I think it's interesting looking at demographics and consumption and how those two interplay. So really a lot of growth in emerging market consumption over the last decade or so has been in China. However, if you look at where China is today, in many ways it's starting to look more like a developed market. And when I say like a developed market, what I mean is the population is currently in the process of peaking. It's certainly an aging population, so the median age in China is around about 40, very similar to what it is in the UK. And so you no longer have a strong tailwind in China in terms of a growing young consumer class. You do still have that very much though in some of the other emerging frontier markets where we're invested. So if you take somewhere like Egypt, where the median age is less than 30, or if you take somewhere like Kenya, where the median age is closer to 20, then you still have a really good demographic tailwind to consumption, and not just consumption of obvious consumer goods as we talked about earlier, but also things like medical services. And we do believe that medical services are a very good way of getting exposure to that growing spending power in some of these emerging economies.
How much does a country's politics impact your investment decisions?
So first of all, I should say that we never try and take a call on politics. So we are bottom-up investors. We're looking at companies and analysing companies, and we're not trying to forecast the outcome of the next election or try and work out what an emerging market political leader is going to do next. Having said that, obviously geopolitics is important, and political risk is material for quite a few emerging and frontier markets. Seeing that right now with Russia. We can see in Turkey that the way in which President Erdogan is dictating the monetary policy of the country, that is really very problematic for Turkey. So geopolitical risk is important, and we have to consider that as one of the risks that gets priced into stocks, and one of the risks we need to be aware of when thinking about portfolio construction. So, as I say, so not taking a call on politics, but very much aware of it and thinking about how that risk plays out in the portfolio.
Sure. And if there's a company that you absolutely must invest in, but they do have that sort of complex political backdrop, how do you mitigate any kinds of risks?
So I think when it comes to mitigating risk, certainly with political risk, it is important that we maintain good diversification in the portfolio. And even though the portfolio is quite concentrated in terms of number of stocks, 45 holdings, I would argue that geographically we are quite well diversified, invested across 20 countries. And we don't have any single country exposure which is excessively high. If you look at the benchmark, over 30% of the benchmark is China. We think that's quite a high concentration for any one individual country, and we don't have that level of concentration in the portfolio. The mitigation of other risks is slightly different. So if you take FX risk, for example, in a country like Russia, where ruble depreciation could be significant, we believe it's important to have companies that both are exposed to that, but also companies that benefit from it. So having a domestic business in Russia like Sberbank, but also having an exporting business like Norilsk Nickel, and Norilsk Nickel benefits from a weak ruble because it makes its production cost even lower in dollar terms. That helps to hedge some of the FX risk that might otherwise be in the portfolio.
Do you have an ESG policy?
So we've always integrated stewardship into what we do, and when we're researching companies, there are three elements that are important to us. So we look at alignment, and that's alignment of management with us as minority shareholders. We also look at capital management, and when we talk about capital management, that is both the track record historically, how they've used shareholders' funds in the past and whether they've used it appropriately, and also their intention for how they use shareholders' funds in future. The third pillar for our stewardship approach is environmental and social risk mitigation. So we don't operate a policy of exclusions. So we wouldn't say, for example, this company operates in the mining sector and therefore it's too difficult to understand and take a call on the environmental risks of this business. We would instead engage with the company and make sure that management is doing what they can to minimise and mitigate any environmental risks associated with the business.
Do you have an example of that?
So we speak with companies quite frequently on this. Quite recently, we actually engaged with a bank called United Bank in Pakistan. And the reason we engaged with the company is because it was showing up as having a relatively high social risk, and that's according to third-party data providers. So we subscribe to a number of third-party data sources, aggregate that data into our own internal tool, which we call ESG Hub, and that raises potential flags or areas for investigation with companies that we're researching or companies that we own. United Bank showed as being a high social risk because there is a history of money laundering in Pakistan. Sure people are very aware of Pakistan having been featuring quite prominently in things like the Panama Papers. So we spoke with the company, wanted to understand what they're doing to mitigate that risk that they don't know their customers well enough or their compliance procedures aren't strong enough. And actually they've had one of the big four accountants working with them for over a year now, I think it's for 2 years, putting in place the right compliance procedures and controls to make sure that actually that risk is very well mitigated. And I think that really shows that we have to engage with companies to understand these risks rather than relying on third-party data or what you might read elsewhere. And I think it also shows that a lot of the third-party data that people are relying on, it really is difficult for that to be kept up to date and truly reflective of just how much the corporate governance picture is improving in emerging and frontier markets. The data is very much behind the reality.
Right. And within ESG, which is becoming increasingly important for investors, is there an area that you'd say is more important in emerging and frontier markets or perhaps is harder to monitor?
So the area that I think is most important is that first of the three pillars that I mentioned, and that is alignment. So alignment of management with us as minority shareholders. So if the management team has got reason to care about the share price longer term, then everything else is likely to fall into position. Because mitigating environmental and social risk for a business, for example, that is not just about doing what is right for the world and for other stakeholders. It's actually about doing what's best for creating shareholder value in the long term as well. So alignment is very important, and also alignment is relatively straightforward to gauge. So we can see what management have in terms of equity ownership in a business. We can look at what long-term equity-based compensation plans are in place. And it's something that we'd like to see. We'd like to see a long-term equity-based scheme. And of course, dividends. And with an income-focused strategy, we're naturally gravitating towards companies that have got a track record of paying dividends. And dividends themselves are, they're the hardest, most tangible possible evidence that companies are aligned with us as minority shareholders and they're willing to give cash back rather than invest the cash in some other project that they are doing for other reasons.
So can I ask how much of your own money you have invested in the trust?
So I've been invested in Jeffy since the trust launched. It is the largest single investment I have. I'm invested across both my pension and my ISA. So it is a very significant holding for me. And I think it's important as a fund manager to be personally invested in the strategy that you're running. And for me, because it is a portfolio that's well diversified across geographies and sectors, because it has that quite respectable level of yield, I'm very comfortable having that large portion of my own personal investments in the investment trust.
Brilliant. I'm sure investors would be pleased to hear that. And finally, how would you describe investing in emerging and frontier markets in 3 words?